Hi again. Let's get started with part 2 of Chapter 4, where we'll learn how to account for the purchase of merchandise inventory. In this part 2 of the chapter, we will learn that the cost of merchandise purchased and that ultimately recorded in cost of goods sold includes more things than just the invoice cost. This is important. The cost of merchandise inventory is reduced by purchase discounts, returns and allowance, and it's increased by the cost of transportation costs, also known as freight in. Let's spend a little bit of time looking at these topics. They can be confusing for students. The purchase of goods on credit requires that both the buyer and the seller agree upon payment amounts and due dates. That should make sense. And we refer to this agreement as credit terms. Now, credit terms vary by industry and also can be changed based upon the volume of a product that a customer is buying. Sellers grant a cash discount to encourage buyers to pay earlier. Cash in our own pocket is always better than waiting for someone else to pay us. Is that right? You'd agree? So a buyer views a cash discount as a purchase discount, which reduces the cost of inventory. And a seller views a cash discount as a sales discount, which reduces net sales. Any cash discounts then are described in the credit terms on the invoice. For example, credit terms of 210 net 60 means that full payment is due within the 60-day credit period, but the buyer can deduct 2% of the invoice amount if payment is made within 10 days of the invoice date. This reduced payment applies only for the discount period, that's 10 days. So terms of 210 net 30 are very common, but at the coffee company that I just was working at, we granted Costco terms of 210 net 21, for example, to reward them for the volume of coffee that they purchased. Again, this varies industry by industry, customer by customer. Purchase discounts then are typically written as shown on this slide. And this particular discount term would be read as 210 net 30. The first number represents a discount percentage. Here, the buyer, can deduct 2% from the full invoice price if it pays within the discount period. So 2% on a $1,000 purchase is $20, $20. Now the second number represents a discount period in number of days. This would be 10 days. The letter N stands for the word net. This means the net invoice is due after considering any returns or allowances. We don't take a discount after we've returned some inventory to the seller. And the last number represents the entire credit period in number of days. And that is the total time the buyer has to buy the invoice or has to pay the invoice before it is considered past due. In this case, if the customer pays within 10 days, then the 2% discount may be taken, and if not, then the whole amount is due within 30 days. With that in mind, let's review a couple journal entries to record the purchase discount. When we purchase inventory, we debit the asset merchandise inventory for the cost of the inventory purchased, and we credit either cash or accounts payable. Now, this entry is similar to the entry we would make if we purchase any asset, like a truck or like land. So to illustrate then, Z-Mart records a $1,200 purchase of merchandise on credit on November 2nd. And so what do you think? Easy, right? Good job. Now let's see how a purchase discount works applied to this purchase. Credit terms were 210 net 30. So the question is, on what day does the discount period expire, and by how much will Z-Mart reduce its purchase cost by paying early? If Z-Mart pays the full amount due on or before November 12th, it would qualify for the discount of 2% because it paid within the 10-day period. In this case, the entry would be a debit for the entire accounts payable balance of $1,200, which is paid off with a cash payment of only $1,176. The difference of $24 is the purchase discount, which is recorded as a reduction in the cost of merchandise inventory. I can verify that this is what actually happens inside the computer when a company uses a perpetual inventory system. If the inventory has been sold before the discount was taken, the system would then default to a credit to cost of goods sold. This is just an aside. For those of you who took Accounting 101 prior to this class, please be very aware. Okay, a note of caution. Accounting 101 teaches you to record purchase discounts in its own account, probably because sole proprietors don't have sophisticated accounting software, or some of them anyway. In this class, you will need to change your thought process and memorize this entry. So remember, purchase discounts reduce the merchandise inventory account directly. Now, if we look at the accounts after posting the payment entry, we can see that the current balance in accounts payable is 0, which shows that the total liability has been paid. We can also see that the current balance of $1,176 in the merchandise inventory account reflects the actual cash price of the inventory purchased. This is a key point for you. The cost of merchandise inventory will always be equal to the cash paid for it, regardless of whether there are discounts, returns, or transportation costs involved. As business people, you should be aware that not taking cash discounts when you are offered them by suppliers is like walking away from free money. It's very expensive from the standpoint of reducing your overall inventory costs. It's also not good money management. Giving up a 2% discount by not paying within 10 days equates to the cost of about 36% a year for the use of those funds for the remaining 20 days. So going back to the prior example, if Zmart does not pay within the 10-day 2% discount period, it can delay payment for 20 more days, but this delay costs Zmart $24, computed at 2% of $1,200. So the lesson here is always take the discount if your company has the cash available, the cash flow to do so. In addition to purchase discounts, merchandisers also have to deal with returns of inventory and allowances. Now, purchase returns refer to merchandise a buyer has acquired but then returns to the seller. And a purchase allowance is a price reduction given to the customer because of some sort of quality issue, okay, like a frayed hem, for example, on a pair of jeans. So an allowance may be given if there's a slight defect in the merchandise or because a shipment was late. In these cases, the customer keeps the merchandise and just receives a price reduction as an allowance. Both of these items, though, do reduce the cost of merchandise recorded in the merchandise inventory account. We'll take a look at a couple examples on the next slide. So assume then that on November 15th that Zmart, who is the buyer, requests a $300 allowance from Trex Company for defective merchandise. Zmart will make an entry on November 15 to update its merchandise inventory account to reflect the purchase allowance. It will debit accounts payable and credit merchandise inventory for $300. It's reducing the cost of inventory here. So here's a point. Zmart will not be allowed to take a discount on merchandise returned or where an allowance has been granted. That would really be poor business on the seller's point. Here's a series of entries then for you that are made when a return is made from the buyer to the seller. To illustrate the accounting for returns, suppose Zmart purchases say $1,000 worth of merchandise on June 1st with terms of 210 net 60. And 2 days later, Z-Mart returns $100 worth of goods before paying the invoice. Notice that the original entry to record the purchase is simply reversed when recording a return. We debit accounts payable and credit merchandise inventory. When Z-Mart later pays the net invoice on June 11th, it takes a 2% discount only on the $900 remaining in the balance. And again, this is an important point that students forget sometimes. When goods are returned, a buyer can take the purchase discount on only the remaining balance of the invoice. Here, the resulting discount is $18 or 2% times $900, and the cash payment is $882 or $900 minus the $18 discount. My point is also true with allowances. Sellers will not allow you to take a discount on something you're not paying for. Transportation costs are the last type of cost that affects the merchandise inventory account. Now, as you probably know, the buyer and the seller must agree on who is responsible for paying any freight costs and who bears the risk of loss during transit for merchandising transactions. This is essentially the same as asking at what point ownership transfers from the seller to the buyer. The point of transfer is called the FOB, or the free on board point, which determines who pays transportation costs. The rule is simple. Whoever owns the goods while they're in transit pays for the shipping cost. So if the shipping terms are free on board, or FOB, shipping point, it means that ownership transfers from the seller to the buyer when the seller provides the goods to the company transporting the goods. That would be the carrier. It also means that the buyer will pay the transportation cost. This transportation cost will be added to the merchandise inventory account. Now, on the other hand, if the shipping terms are free on board destination, FOB destination, that means that ownership transfers from the seller to the buyer when the buyer receives the goods, when they take possession at their place of business. It also means that the seller will pay for the transportation cost and no entry is made on the seller's books. So please spend a little time making sure you understand how these rules of ownership transfer really work. And here's an example for you, journal entry-wise. When a buyer is responsible for paying transportation costs, the deal is made FOB shipping point, for example, the payment is made to either the carrier or directly to the seller, depending on the agreement. To illustrate, Z-Mart pays an independent carrier $75 freight charge for merchandise purchased FOB shipping point. So the entry is a debit to merchandise inventory and a credit to cash for $75. And here's another important point. Cash discounts, again, are never granted by the seller on the cost of transportation because transportation is an add-on service. It's not merchandise. If this merchandise was purchased with 2% 10-day credit terms, 210 net 30, or sorry, 210 net 30, the buyer would not deduct 2% from the cost of the freight. So please be sure to make a note about this. On this slide, we see Z-Mart's itemized cost of merchandise purchases for the whole year of 2015. So in summary, purchases are recorded as debits to inventory, merchandise inventory, and any later purchase discounts, purchase returns, and allowances are credited or recorded as decreases to merchandise inventory. And finally, transportation in is debited or added to merchandise inventory. I provided a slide about the summary of inventory purchase transactions that we covered here for you. They talk about purchases, discounts, returns, and allowances, and freight in. It's for your reference only. You can find this information in the book as well. So At this point, let's move on to the third part of Chapter 4, where we discuss how to account for merchandise sales. See you in a few minutes.